Let's start with the first question from Sam regarding the recent market volatility. So, any thoughts on recently the market has been really volatile, and do you anticipate it to be increasingly more difficult to take advantage of it in the short time that it occurs?
That's a good question. I do think that volatility volatility has been low for some time. We went through a period of 0% interest rates while we built out this fund. And there was a period where the VIX was trading sub 10 for an extended period of time. I think we had 90 days straight with the VIX, which is the volatility index, trading below 10. A week ago, Monday, I think it spiked to 65. That's extremely rare. It's usually an outstanding opportunity. When the VIX spikes, the premiums that we receive on our option contracts go up. There's more uncertainty as to the prices. People are willing to pay more for their protection. And a lot of that's done based on just quantitative metrics like volatility. But the way we're looking at things is the underlying business value. So if the market's volatile, that can be an opportunity for us. So when volatility spikes, we get paid more for the contracts that we're looking to sell. Look, there was a period where you could just throw darts and everything was looking really cheap. In 2022, things were very cheap. And now we've seen things come up considerably. So I expect there to be some rotation where maybe smaller caps can get some more. There will be capital flows going to the Russell 2000 firms that have been sort of sitting at a lower level of valuation. So I do think that we're going to have much more volatility over the coming years. The S&P has grown at a really strong rate for a decade and a half. It's truly not sustainable. So the S&P doing 6.8% for 200 years is a real number, and we will revert back to that mean. And if we've just had a 15% decade, we're going to probably have some pretty low returns to normalize things. So I expect things to be flat, volatile. This is for the index, not for our individual holdings. But if you're just an index investor, I think you should brace yourself because things have come up considerably. We've gotten ahead of the economy. Now the economy needs to grow into the current prices, and there will be some fear, volatility. There's a number of external factors that can, we have a lot of political unrest. We have elections going on in the US. We have a number of considerations that can quite easily create a volatile market.
Thank you so much for the first question as well. The question will be, how do you utilize the free cash flow of a business to assess its overall financial health and make the investment decisions?
Yeah, hi, Javid. Great. So the cash flow of business is extremely important. It's in many cases more important than the earnings of the business. A lot of times people overlook that because management can control what they report in their earnings, and the internal cash flow is a little more transparent. So what we're looking for is growing cash flow. We're looking for growing margins, and we're looking for opportunities where the price might have come down irrationally due to some short-term factor or event. And what we're also looking for is an outstanding management team. So if we have really clear growing cash flows, that's outstanding. Now, the business owners can take that cash flow and do a number of things. They could reinvest that in the business. They could pay debt. They could issue a dividend. They could engage in some merger or acquisition. And some of these activities are going to expand the business and add value to the business, and some are going to destroy value for the business. So having really strong, positive cash flow generative business model is highly important, but it's also essential that you have a really strong management team that knows how to allocate that capital. There are a lot of firms where the leaders of the firm have moved up throughout their careers because maybe they're really good at internal politics or they're managing for different variables. What we're looking for is the top capital allocation players being at the top of the firm where they're receiving a large amount of cash flow and then reinvesting that very intelligently into the market.
All right, thank you so much. And the next question going to a little bit international to the Chinese side, all right, which is on your holdings on Alibaba. Question from Krishna. He's wondering like, how is Alibaba being held as a US stock or Hong Kong stock, and any rationale behind this approach? And there's also another listener wondering about with the slowing growth in the Chinese economy and increasing debt and US-China tension getting even greater, how would that impact on your assessment on Babas in the future?
Great. These are all great questions. So you may not love this answer, but we have derivatives on a VIE. So we have call options on the ADR, which is the VIE structure that gives us access to the ownership of Baba. All right. So we watch that quite carefully. There is a contractual relationship. We believe that the Chinese government requires capital markets. It would be very strange for them to sort of destroy things. Where the VIE structure could break down is possibly with a smaller firm, probably not with Baba. But if we saw that happening with a smaller firm, then we would question what would happen with Baba. So we'd probably see pretty far in advance, similar to hopefully what we saw with Seritage. So we noticed Seritage long before its real decline, and we were able to exit. So if there's something threatening the current structure, I believe that we'll see it quite early. Regarding the slowdown in China, it's tricky because oftentimes to find great value, you really have to go to where there's blood in the streets. So as a value investor, you have to sit there and look wrong for a long period of time sometimes before things start moving in the right direction. So you end up looking in places that a lot of people don't want to go. There are a lot of challenges with China. There's challenges with the GDP. There's challenges with the economics. And of course, there's tensions between the US and China. However, Baba is truly an international business. They are operating all over the world. Their earnings and cash flows are growing, and they're looking to exceed, 25 billion a year coming up here in a year or two. They'll be hitting that consistently. So if excluding their cash, their whole business is only 150 million, it's like 6 years until they bring in the cash that replaces the whole business. So we find it very unlikely that we will lose money on this Baba opportunity. Baba is truly a global player in the cloud space, AI space, and technology space. Baba, Tencent that we own through our Naspers position, along with Google, Amazon, Microsoft, and some of the big US players. These are the players, and we're so pleased to own a piece of it. And it's a global player. We think it should compete globally. We think in the long term it will be competing globally, and it should be priced globally. So right now we have the Amazons and Googles of the world trading for trillions, and Baba earning 20 plus billion a year has recently been selling for under 200 billion. So this is a company that has a long runway ahead of it. Years ago, although Munger reversed his position, Munger started buying in for $200 a share. We've been buying in more like $80 a share. And we've been using our wheel strategy to buy in the money call options. So our exposure is right now through the calls. And the calls are actually quite volatile. All right. So we do see volatility in our portfolio, but these call options go out until December of 2026. So we have in the money call options that we've accumulated for very low prices. In some cases, they've been totally free, and we've packed our portfolios with these. We have call options right now on 200,000 shares of Alibaba. And our plan, because we don't have all the cash today to buy all of those calls. All right. So our plan, if we reach December of 2026, first of all, we may bring in that capital. We're raising capital every single quarter. We also have our structured dividend capture, which is generating cash for us every single month. So we may raise the money to buy that, but the ultimate plan is to use half of the calls that appreciate to purchase the other half. So it's the move that Buffett did when he was buying Goldman Sachs. He was reinvesting in Goldman Sachs in the financial crisis. He was investing in Bank of America. He was getting these warrants, and then when they expired, he would sell half, and he'd use that cash that he made to make the full purchase, and his stock ended up being free. So that's the method that we're using. If they buy back their shares and we buy our entire position, we will own 0.01% of BABA, which is absolutely astonishing. If BABA becomes $1 trillion business over the next 20 years, we will own $100 million of that business.
How wonderful. I love how you integrate value investing and Buffett's principles in your fund's philosophy. Now, since we're talking about options, the next question goes into the structured dividend capture strategy that you are applying. From Krishna, he's wondering how much percentage of the portfolio appreciation actually come from SDC last year. And he can see that the approach as the bull and bear market is bull and bear market independent. Is this assessment correct? And as the AUM increases, do you see these strategies still being feasible?
Yes, this is very feasible. We can scale this into the hundreds of millions. In fact, if you look at the companies that we're applying this to, many of them are 100, 200, $300 billion firms. And so there's a huge market for these. This is also only a piece of our overall strategy. We have our existing infinite compounder portfolio. So if you imagine that we're running, say, 20% cash through this, our portfolio could be absolutely huge. We could have a $2 billion portfolio and still be executing our structured dividend capture on 20% of our internal portfolio. So we really can scale this strategy. There's nobody else doing this. The space is wide open. It's quite sad, actually, because we don't have the capital. We just watch this pile of gold expire every single month. We can't capture it all. So I encourage all of you to go out there and try and capture some of this. This strategy, based on our back testing, is evolving. Okay. And we're not always putting the same amount of capital into the strategy. But if we were to apply the attribution last year, attribution would be about 30% coming from structured dividend capture, and the rest, the 70%, coming from the remaining portfolio. But let me tell you a little detail. When I showed this slide of our ownership. Our portfolio currently is a little under 24 million, but our ownership is like 24.5 million. Okay, so technically we have a little bit of our core infinite compounders on margin. All right, we have like $1 million in margin on a $20 million portfolio. We have about 5% in margin. So we are still executing structured dividend capture, but we're executing it more out of discipline. We've reduced the amount that we're putting into each of these opportunities, but as we raise more capital, we will definitely be putting that capital into the structured dividend capture opportunities. We have now, because we recognize things like selling the put in the money, and we recognize things like how quickly and how much of the time volatility decay over the last 21 days, we now have extended the duration on the puts, and we write them in the money, and we're drastically augmenting our expected results. We're almost doubling our expected results. And we thought we were being conservative previously selling out of the money puts, but as we analyzed through Monte Carlo simulations, we realized quite clearly that we're capturing everything that falls and nothing that is flat or going up a little bit. And so by simply selling an in the money put, we still capture all the ones that fall, but we capture a lot more that are flat and go up. And then we get those dividends and the premium for the call as well. So we are really improving the strategy all the time as we move along. I'm quite confident in these results. They're astonishing results, 24% annualized over 20 plus years. And we're running this algorithmically based on what we would do today. We're going all the way back 20 years and saying, run the software on the 13Fs, tell us the companies we'd buy, and tell us what would have happened. And what it told us is 24% annualized with a little bit of volatility. It's amazing. And so we will be executing this. What this also does is allows us to be incredibly patient. Imagine the value fund sitting there with 20% cash. That is a drag on performance. Everybody's competing. We're all trying to get the highest numbers, but we're trying to do it safely. And so value funds tend to hold cash so they can allocate it to the new opportunity coming in the future. They want to make sure they have that opportunity. We've now developed a way to hold some cash, but not have it be a drag on the fund. And we don't need to allocate that to a 10% opportunity annualized. We can be patient. We can wait for that 20, 25, 30% annualized opportunity because it's not going to be a drag on our portfolio. And so as we raise more money, we will absolutely keep investing in the structured dividend capture. Right now, the whole portfolio is the infinite compounders. That's not a terrible thing. Our infinite compounder portfolio is amazing. But as we raise capital, I think we're going to see our returns go up.
Oh, wonderful. And I can see some of the audience are very eager to get their question answered. I will be addressing that question in a while because the next question also follows up with the structured dividend capture. Regarding your strategy on SDC, have you ever encountered a situation where the stock was assigned in the put and subsequently the stock price actually fell below the cost basis, making it difficult to exit with a cover call above the cost basis?
Yes. So that happens. We're actually in our divergence analysis, we're trying to analyze how frequently this occurs in a given quarter, because if we can manage our expectations, it's not as alarming. We had this happen with Icon Enterprise. Icon Enterprise was paying a really high dividend and it looked somewhat unsustainable. They were funding some of it with debt, et cetera. And it doesn't even need to be, by the way, to clarify the question, it doesn't need to be that it was assigned. It can be that we've just sold the put. So while we had sold the put, the shares declined from 30 to 20. Under 20, it fell about 33%. And during that period, we were selling calls, but as the price declines, they don't get called away. And so what ultimately happened was the shares were selling for maybe 31, and we sold a put at the time, which was actually not what we would do today, but we sold it out of the money. So we sold a 30 strike put and picked up about $2. And then the shares started to fall. So as the shares were put to us, we were scheduled to get a dividend. They actually cut the dividend. So the dividend got cut in half. And we then just continued selling our calls. Week after week after week, we were selling calls as it declined. And ultimately, we picked up $2 for the put. We picked up another $4 in calls as it was declining. We ended up exiting for $20. So in the course of that entire fall from above 30 to below 20, which would have been a 30% decline or more if we were holding the stock, we exited and we had about a 10% decline. And keep in mind, we're doing this on a basket. So although I showed you this Gantt chart that says start with Chevron and then go to Johnson & Johnson, then go to Fox Corp, that's not what we're doing internally in its extreme. We are analyzing these 13Fs, and Alpha One is providing with us with about 40 opportunities per quarter. So we turn that into a basket. We divide our capital by the 40 opportunities, and we allocate to each one. So in the case of Icon Enterprise, we were allocating 1% of portfolio capital. The stock fell 30%. We fell 10%, but it's totally insignificant because it's in a basket and other gains make up for the Icon Enterprise loss. And that's a pretty extreme loss. So when does structured dividend capture not work? during a flash crash or something where everything goes down and stays down. We will get put that. We will have a slight margin of safety because the put premium will bring our net cost below what it was originally. And then as we sell calls, by the way, we'll see a VIX spike and volatility spike. The call premiums will spike, and we will then sell a call during heightened volatility and make up a lot of the declining stock price. But generally, what we want to avoid is the whole market declining. If the market just steadily declines, or if the market's flat and volatile, we will do very, very well with structured dividend capture. It's just the sudden declines when it goes down and stays down that we take a little bit of a hit.
It's how wonderful that you guys are using structured dividend capture to lower your risk, at the same time increase your return in the long run. Now, the next question comes from Adrian. He's wondering, when you do back testing, do you take liquidity into account? And at the same time, regarding the data that you are using, Mahindra is wondering, what data source do you use for 13F sourcing? Trying to understand the reliability of the data here.
Where are we getting the data for the 13Fs from, Andrew, right now?
Yeah, so the SEC has an API that you can directly get the 13F filings from. So we are processing those 13F filings directly in order to generate our 13F summaries. So it is directly from the SEC.
Yeah. So the data integrity has been a real issue. We started with data going back 7 years, and we found a number of challenges, just data that was totally absent. We had to go out. We personally went out and bought data. We don't buy or do our research or build software with fund capital. We build it with our own capital and then use that to help grow the fund. So we basically went out, purchased data. We found a much higher quality data source, and we don't consider liquidity necessarily, but I assure you, like, we have a $25 million fund. If we're trying to put 5 million through 40 companies, there are zero liquidity issues. Every option represents 100 shares. So if you take something like Baba and write one contract, you're allocating 10 grand with one. And it's just, you could put 1,000 through in a second. So we are so far away from a liquidity issue. In fact, it might be worth mentioning how long this has persisted, because I didn't think it would last. When I was looking at structured value originally, I discovered or kind of created this method very independently when I was working out at Goldman 20 something years ago. And I took it to Goldman and said, we could do this. We could start a fund where we sell puts and we'll get stock and it'll cost us less. And we did an analysis and we decided, okay, we could easily put 250 million through this, like right now. This was 20 years ago. And we wouldn't impact liquidity. We could take any position we wanted. And actually, Goldman wasn't that interested, because to build the entire business and then maybe return 20%, and then so we get 50 million, it doesn't move the needle, and there's costs. So it wasn't something Goldman, or I think most Wall Street banks, want to engage in. There's this fear of liquidity issues, but there are a lot of people out there using options for different purposes. I have quite literally never experienced a liquidity issue in my life. It's strange. There's enough liquidity. If you got into a real small cap situation, maybe you'd run into trouble. But currently, we're nowhere near the boundary.
Right. Thank you so much for addressing this question. The next question is revolving around Alphabet. What are your thoughts on the possible breakup of Alphabet by monopoly regulators?
Well, I hope that it doesn't come to that. I think that Google has so many internal businesses that are under monetized. Even a breakup would probably unleash some value. Google is growing in every direction. Google has so much data. Google is at the forefront of AI. Google has outstanding leadership. You know, they do more or less have a monopoly on search. I don't anticipate it being broken up. I think it will be kept together. I think there's a whole new focus on AI, and I think that search is, quite frankly, under threat. So we'll see how hard the regulators push, but obviously they're looking into these things. I don't think a breakup would cause the firm not to grow to its full potential. I do agree with that, but I don't think a breakup would make the shares go lower in aggregate. It would probably still release some value. So we would prefer the firm stay together. We monitor these activities closely. I don't think a breakup would change our holdings, but then we would probably adjust certain spinoffs and breakups accordingly. But we'll cross that bridge when it comes. We're going to hold right through until we find out answers to these questions.
All right. The next question is from Fen Patel. He's wondering, where do you project the fund to be in the next 3 to 5 years? And recently, have you been reading some books or articles? Do you have any insightful takeaway that you want to share?
I think that we can cross 100 million in 5 years. We'll raise capital, we'll grow capital. You know, we're at 25 million. I think we could reach 100, and I think we will reach 100. If not in 5 years, in 6 or 7 or 8. And I think we'll still be at the beginning. We'll just keep compounding. I think we have a really long runway ahead. I started this firm when I was 30 and I'm 44 now. I don't expect to do much else with my life. So it is what it is. I'm going to be sitting right here. So 25, 30 years from now, hopefully we can hit our 10,000% returns. But the next 3 to 5 years, I think we have just incredible opportunities through our AI, through our software that we've developed. We're actually being presented with opportunities to create capital that we would never have seen before. We're really at an inflection point. We have some really, really nice tools here. So I expect us to continue growing. We have, I think, 77 LPs currently, and the fund structure allows for 99. All right. So we have like 22 open spots. I expect those will get full. Redemptions is a normal part of life. Some people redeem, they'll retire, they'll build a home, they'll do their dreams. So there will be some positions that are some spots that open up, but I expect we'll have a wait list. I don't think a lot of people will want to leave. So we're going to get our 99 LPs together and just focus on compounding.
That's awesome. And regarding the question on what's your recent takeaways from some of the books or articles that you read?
I often talk about a few books. I really like Howard Marks' books. I really like, of course, Poor Charlie's Almanac. Peter Kaufman just released a new version of Poor Charlie's Almanac. That's fantastic. Todd Fink wrote a book, Warren Buffett, Investor and Entrepreneur. It's amazing about his life growing up with the Buffetts. I've gotten to know Arnold Vandenberg. It's been a huge pleasure to get to know Arnold over the last couple years. I think if you asked him, if you haven't read The Genie Within, I think that's probably one of his very personal favorite books, The Genie Within. Some less conventional books that are good. There's, Napoleon Hill wrote Think and Grow Rich, is an outstanding book. There are so many. You can read all of Buffett's letters. You can read Pabrai's book. You can read Guy Spears' book. You can read William Green's book. You can read 100 Baggers by Chris Meyer. These are all fantastic, fantastic places to start. And if you don't feel like reading, you can watch Chloe's podcast, The Arigato Investor.
Thank
He's
you.
educating the world.
Now, let's go to the next question regarding once again on some of the alpha technology that you have developed. So Andre is wondering, will your alpha technologies or structured dividend strategy ever be available as a subscription for small retail investors?
I mean, we think about that stuff sometimes, but we've built this internally. So it's not like we're not pressing to really get this out. Our focus is really on compounding the capital. I presented it to Century Management on a couple of occasions, and they're interested in all this functionality. But right now, we don't have an established platform where we can lease it. But let's see, if somebody's very interested, let us know. Maybe we can work out something. Right now, it's really for internal use, internal risk management. I mean, this software is incredibly valuable.
And talking about, once again, going back to your investment, can you explain what the bottom-up investment approach means and how does it differ from the top-down approach?
Yeah. So all bottom-up means is that we're looking at individual businesses and how that business can compete with its peer, with its competitors, and grow in the environment. So we're looking specifically at a small business. It's microeconomic analysis. What other funds do, many funds are out there doing different types of analysis. Many funds are out there doing macro analysis, which is top-down. And unfortunately, it's been proven a lot that top-down analysis doesn't work very well because macroeconomics is inherently so unpredictable. There are so many variables. There are fat tails, right? There's all sorts of statistical analysis where Nassim Taleb and in like Black Swan and things prove that the tails of a normal distribution are fatter because situations that happen at the extremes that are irregular and we don't evaluate those. So yeah, we're very focused on all of these different aspects of our analysis, and we are always evaluating these aspects.
All right, thank you. The next question goes back once again on the SDC. Is the cash held to cash secured puts earnings treasury or market rates like around 5% now, or how does that work?
The cash, when it sits in IB, we're given just a little bit of interest. And IB is pretty competitive, both on their margin rates and on the interest that they pay. They're very competitive. So we can't do much better other than maybe going into treasuries and whatnot. But what we're really doing is we're running structured dividend capture on that cash. So if there's cash sitting there, it's earning a very small amount of interest. But we're redeploying that and trying to grab a dividend every week or two. So we're artificially creating more, it's cash generative for us. So the cash sitting around in most value funds sits there. But in our fund, we're actually allocating that and then pulling it back to cash, allocating and pulling it back to cash on a regular basis.
And following up on SDC, what's the tax rate applies to the dividends received?
In our long-term portfolio, we are super cash efficient. In fact, if we don't sell, it's all unrealized capital gains. And if we do sell, it'll be treated as long-term capital gains. In our structured dividend capture, because it's short-term, it is treated as income. It's all treated as income. We don't love that aspect of it, but it's a very high yield and it's available for us. So we're going to go pick up that cash. What happens, as everyone in the fund knows, you receive a K1 in March each year before March 15th. It's usually coming between March 1st and March 15th. Everybody asks me on March 1st, and Spicer's usually finishing it up. That K1 is then used for everyone's personal taxes. So if we had gains that were realized, it will be broken out into long-term versus short-term. And of course, if there's ever a tax liability that is burdensome, we don't encourage this, but you can always redeem. It's like if we've made 50% and then you have to pay some taxes, You don't have to be that upset about it. You can just redeem a little capital, pay your taxes, rather than, struggle to pay your taxes. So if we make money and have to pay taxes, that's an okay problem to have. We love it when we can compound without paying taxes as unrealized gains. Unfortunately, with short-term dividend capture, it's all treated as short-term and it's all treated as income, but that's okay. So we have a little bit of cash generative income within the fund. It's a nice engine behind the fund. And if anybody needs capital to pay some taxes, you can redeem a little bit and meet those liabilities.
All right, following up from Dylan regarding SDC on Southwest, he understands that in the past, Southwest is a stock that you've executed SDC on. Do you guys monitor stocks that you perform SDC on as potential holdings? And he knows that generally airline is a notorious industry. So what's your take on that?
It's a little different. I would not want to buy Southwest Airlines as a long-term compounder. However, when we're running things through structured dividend capture, we don't actually care if they grow. All we care is that they don't fail in the next month. We generally are looking at larger, stable companies. They pay a dividend. A lot of times they're larger cap firms. And because the more stable companies are the ones paying these dividends. So we could potentially run structured dividend capture on something that we end up owning for the long term. We absolutely could be doing that, but that's typically not what's going on. What happens is, and to give you a few metrics, when we do our 13F analysis, we're analyzing over 100 high quality value-based funds. All right. And those funds are usually concentrated and they're low turnover. So multi-billion-dollar asset manager makes a multi-$100 million investment into something that's of interest to us. And when they make that investment and everybody making their investment, we run this Alpha One software and it runs all the analysis and it gives us our divergence analysis and it shows us the superset of companies that are owned within these 13Fs. So if there are, say, 5,000 publicly traded companies available in the US that we might be looking through to buy, the superset of every company on all these portfolios is roughly 400. So we automatically eliminate 95% of the market, 90% of the market. And we're sitting there looking at a few key firms, hundreds of firms. But then further, when we start running our analysis on determining what we can run structured dividend capture on, we're still starting from that pool and ultimately pull out about 40 firms in a quarter. So we've narrowed this market down from 5,000 firms to 400 firms to 40 firms. So we're taking 40 firms every quarter and running structured dividend capture. And those firms are changing some are consistent, but some change every quarter. So obviously we have a 7 holding portfolio. So we are looking at these. We look at them more carefully than other firms, but the intention is not really to own them for the long term. We're just grabbing a few dividends. It's actually very much zero sum. So in terms of the long-term value investing, we don't look at that as zero sum. We're adding value to the firms. We're adding value to society. We're adding value to all of you. We're not taking value from somebody else just by owning the shares. But when we're engaging in structured dividend capture, unfortunately, that is just a zero-sum transaction. Somebody else, we believe, has made a mistake. And so we're just selling that to them and collecting that money, and then we just flip it back to cash. So although we do evaluate them, these are really short-term holdings. We need to sort of be sure they're not going to have a major problem in a month, and we can't always be positive. We talked about Icon Enterprises, but for the most part, these are larger, stable, sometimes just blue chip companies, and we're just selling a put to get the dividend, selling a call, and getting back to cash. We're not looking for long-term ownership of the business.
The next question comes from Alan. He's asking, what's the percentage of time that you guys spend on SDC versus analyzing long-term stocks for holding?
Yeah, it's a great question. It's a little opportunistic. So, right now we're fully invested. And so we're always, it's just my passion. We're always looking around at new opportunities. We're always trying to find the next way that we can make a 10x return on something. So we always have our eyes open. There's a lot of different channels that we get it through. Sometimes it's through these 13Fs, and then we're always poking around looking. We get these 13F analysis, and now we have a whole prioritization. So we know the prioritization of the firms that we want to be looking at and analyzing. So we're constantly trying to look through them, maybe just getting a sense of things. We also, one of my favorite functionalities in Alpha One, just because it's so convenient, is we have a calendar generator that basically goes out, uses AI, goes out, it searches the web, it pulls up every company meeting. They announce them just a couple weeks before they happen. So it goes out and it finds all the meetings and it pulls all this quantitative data and it makes a meeting invitation. All I have to do is open it up and click on it and it just plays in the background. We listen to earnings calls all day. We can just play them and keep working. We can work on structured dividend capture and have an earnings call playing in the background. So this is just a constant thing for us. I'm quite frequently attending a presenter at a variety of events, some of these value events, things that happen sometimes at Berkshire Hathaway, but also in Switzerland and Dubai. There's a community of us value investors that are constantly sharing ideas with each other. It's very difficult for one person to find every opportunity in the market. I would say more than half of our time is spent analyzing long-term companies, but the Alpha One process is aiding our efficiency in analysis. So because we're able to generate an analyst report in a day and review 20 pages, that jumps us ahead of someone else who's doing it manually over a week and a half. So we are constantly finding shortcuts, efficiencies, and ways that we can move through our process more quickly. But right now we're fully allocated. So until we raise capital, not only are we fully allocated, but we're fully allocated. We have some call options. We need to raise capital to buy the rest of our Google. We need to raise capital to buy the rest of our Baba, and we need to raise capital to execute our structured dividend capture. So we're constantly looking for new ideas. We actually have way more ideas than capital. We have way more that we can do. So we just keep going one foot ahead of the next.
All right. So the next question comes from myself, since I have the privilege to be the host this time, because I think we have more or less answered all the questions inside the chat. If I ever miss your question, feel free to just put it in the chat again so that I can raise it back up after this question. So Matthew, what's your take on Berkshire's, Warren Buffett's recent selling on Apple and BAC? And right now, like the cash amounts to like $270 over billion. Do you think that we should be more cautious in this market? What's your take?
I think that part of the reason for selling Apple is because he's not really one to trim, but it became such an overwhelming piece of the portfolio. And there's so many investors inside of Berkshire. I think it's somewhat prudent for him to cut this. It's also a bit expensive. He's not selling it because it's cheap. Okay, Chloe, he's selling it because it's expensive. And having 277 billion or whatever it is in cash right now in treasuries, mind you, gives him a huge arsenal to put that capital to work. And I don't necessarily think he'll put it to work until we hit a recession. Buffett can sit there and hold this capital for years, and he's earning about 5% on that capital. So it's not terrible. I do think that he is a little more cautious. Buffett is a great market timer. He always tells people, don't time the market, it can't be done. But he's not trying to time the market. He's really disciplined and allocates his cash only when there's an opportunity. So the cash builds up when he doesn't find the opportunity. But Buffett is very different than us. Buffett is trying to allocate 277 billion, and we're trying to allocate 2 or 3 million. So there are plenty of opportunities to put $1 million or 2 to work. There's a lot of opportunities, but there's not a lot of opportunities to put hundreds of billion to work. There's only a few companies that they can really go after. And so they really have to wait. He's trying to be greedy when others are fearful. Well, he's not going to get that level of fear until we get into full-on recession. So I think Buffett will use that capital to pick away at a few companies. You've seen him buying them, but I'm guessing he's anticipating probably at some point we will have a big recession. It will happen. I think probably we have a few more years to go in this bull market, probably full of market corrections, which is normal, which can present us with opportunities. It's really nice to be a small, nimble fund when the markets are flat and volatile, because we can do things that larger players can't do. We also have a longer term focus, so we can buy great companies and ride through the volatility. I think Buffett's becoming a little more cautious, and I just can't overemphasize how outstanding this is to be alive while Warren Buffett is alive and Warren Buffett is managing a company and you can just own it. It's what an opportunity just sitting in front of all of us. You can put your capital into Berkshire Hathaway and you don't have to change your investment because Warren Buffett's doing it for you. He sold your Apple. Now he's back into treasuries. And when there becomes a great opportunity, he'll put that cash to work. So we look at Berkshire as a very contrarian position. It's growing. It's such a nice stabilizer in the portfolio because as things happen, S&P comes down, there are opportunities. Berkshire will become stronger, more robust. It will allocate cash in a down market and accumulate great opportunities. So it's a great holding to own. I prefer owning Berkshire over owning the S&P. In fact, if that would be a very normal trade-off. If you're finding yourself sitting in the S&P, which holds a lot of, I think, quite expensive companies, you can just rotate that into Berkshire Hathaway, and you now have a nice managed fund that's run by Warren Buffett.
That's perfect. Thank you. And there's Ashif. I think he just joined in, and then he said that have you already answered whether you own Fairfax Financial personally for clients or for clients?
No, Fairfax is a great opportunity. We don't own it. Insurance company, Seth Klarman, and I'm sure it will do very well. It will do really well. And if you own it, it's a great company to own. I think you hang on to that. You know, there's a lot of great companies out there. It's just a matter of getting the right price. And then you also need to make sure that it fits perfectly into your portfolio. So if we have quite a big position in Berkshire, do we want to have Markel and Fairfax also? Or do we want to have Baba and Talis? So it's just a matter of having some internal diversification a bit, but I think Fairfax will do very well.
Since we are talking about Berkshire, the next question Alan is asking, will you reduce Berkshire once Buffett is no longer at the helm? Also, are you hunting for the next Berkshire?
Yes, we're always hunting for the next Berkshire. We will not reduce just because Buffett's gone. I bought my first share of Berkshire, I think, in 2002. And I believe then people were telling me at that time that they're going to wait until Buffett dies so that they get a dip in the price so that they can buy. And what can I say? Sure, sounds like a fine strategy. I don't believe that's a good strategy. And look what's happened. 20 years later, he's still sitting there on stage with us in Omaha, Chloe. So, and Buffett himself has talked about this and said that actually when he dies, he thinks the stock will go up because the uncertainty of the death will be removed and everything will move forward smoothly. So Munger, when he was around, said things like, if the Munger family members sell when we die, you will do worse. So that seems like a pretty clear message to hold. I actually think that Buffett's estate continues to hold his shares for 12 years after his death. It's 12 years later that his assets get settled, and then they'll be transferred to a variety of nonprofits, foundations, and they'll be spent possibly at a rate of 5% a year in a 501c3, although they might not even be spent at that rate if they have other assets to spend. So it's not like Buffett shares are going to get sold. There's not going to be any immediate downward pressure. I think we have more than a decade after Buffett dies where the shares continue to climb. Buffett didn't design this for his lifetime. He designed this for a true legacy. I mean, this is going to be the strongest company in America. So, we'll very likely just keep on holding. This is an infinite compounder. So, and I'll share with you, I have a minor Roth IRAs for our children. We have Berkshire sitting in there. We have Daily Journal sitting there. I expect my daughter to have that when she's 80.
That's beautiful. And I think we also have some potential new partners on the call. Can you talk briefly about the logistics and underlying operations of the fund, including the minimum investment criteria and fee structure? And how does the fund actually ensure transparency and communication with its investors?
Yeah. Okay, sure. So we have two share classes for the fund. We have a zero management fee fund, which is highly uncommon, unusual. We charge 0 to manage the assets. We have a 5% hurdle rate each year, which means we don't charge anything as we make 5% returns for people. We only charge above 5%. We charge 25 on our performance that exceeds 5% each year. We also have high watermarks. So if the fund goes down in a year, we don't charge the next year until we've made up that high water. We've never double charged. We never charge until we've made up and reached that old high water mark. And then we need to exceed our hurdle rates before we get paid. So that is a very compelling model because we are only successful if you are successful. Our zero management fee class is for 2 million and up. We have a 2 million minimum commitment. We also have an exception class for under 2 million, drops down all the way to 250,000. And we charge a very small 0.9% management fee. That's truly the only difference. We still have the 5% hurdle rate. The performance fee is 25% of what we make over 5% each year. We check that on December 31st, and we don't even check. Our administrators handle all that. And that's basically the structure. So if you care to join, if you're interested, you fill out a subscription document, review the legal LP agreement, and you wire the funds to our new Chase account. And 250,000 is a place where a bunch of people start, somewhere between 250 and 2 million. And actively we work together. People are adding to those capital bases and we're growing the capital. And I'm expecting all of these LPs to reach the 2 million minimum, and we'll drop their fees to 0. And if we have 99 partners with 2 million each and we're compounding all of that, trying to get our 10,000% returns, we'll have a huge business and fund and firm.
That's awesome. And I think it's almost time for the last question. What is your fund's core philosophy? And has your philosophy actually evolved over the past decade?
Look, our core philosophy is a value investing philosophy. Everything is centered around value investing. Even when we're doing transactional opportunities with structured dividend capture, we still recognize that there's an opportunity to sell something, a put contract that's overvalued, and then buy it back when it's undervalued or maybe when it costs 0. And so the core philosophy in everything we do is value investing, but we have a lot of key principles. I mean, we're truly a partnership. So the way that Andrew and I operate is that we're stewards of this capital on your behalf. We're fiduciaries for this capital. We are looking for every opportunity to grow this capital. We take risk management very seriously. Basically, all of my money is in the fund. I mean, I have literally like 100% of my money is in the fund. I'm fully committed and allocated. Yeah, so I think the core philosophy comes from value investing. We have been following Buffett and Munger's rules and philosophies for decades. Everything evolves. All right, there are little things that have evolved, certainly. Our level of concentration has evolved as we recognized how important and in fact necessary it is to concentrate to give yourself the opportunity to outperform an index. If you're not concentrated, it's going to be impossible. So these types of subtle evolutions have taken place, but really it's very consistent. From day one, we were selling puts as a tool to buy stock. From day one, we were selling puts on Berkshire Hathaway to own the Berkshire Hathaway as one of our core holdings. In fact, many of our holdings we've now held for almost 10 years. So we're not engaging in turnover. We're not engaging in high levered activities. We are a really core, simplified, best practice-based fund following value investing principles.